Right now, someone with a modest amount saved for retirement is watching this video, and someone with well over $1 million saved is also watching this video. Both are going to get very different things out of it. The playbook changes completely depending upon where you sit. What protects one level of retirement wealth can actually hurt another. So today, I want to walk you through the 5 levels of retirement wealth in Canada, what each one looks like, what the primary risk is, and what the planning priorities are, not generic advice, specific to where you sit. Let's find your level, and your plan should be built for your situation, not someone else's. Hi, I'm Stefano Francesca, Certified Financial Planner Professional and Senior Wealth Advisor at Next Step Wealth Management with IPC Securities Corporation. Let's get into it. If you find this helpful, please like, comment, and subscribe. It helps more Canadians find this content. And if something we cover today connects with your situation, there's a link in the description to book a consultation. The first level is financially vulnerable. This is a Canadian heading into retirement with limited savings. Government benefits are going to be the foundation of retirement income, and there is not much of a portfolio cushion on top of that. The primary risk here is straightforward, running out of money. Not tax optimization, not estate planning, just running out. The first priority is creating sustainable income, and that's primarily through maximizing CPP. Every month you delay CPP after age 65 increases your benefit by 0.7% up to age 70, a 42% permanent increase if you wait the full 5 years. For someone reliant on CPP and OAS as their primary income, that income matters enormously. It is indexed to inflation and guaranteed for life. A higher CPP benefit is one of the most valuable decisions available at this level, if there is any way to manage in the meantime. The second is OAS and GIS. For Canadians with very low income, the Guaranteed Income Supplement adds a meaningful monthly amount on top of OAS. Now, GIS requires an annual tax filing to maintain it, so be sure to file each year and file on time. The third is provincial benefits. Many provinces have programs for low-income seniors. Pharmacare, dental, subsidized housing, property tax deferral that are significantly underutilized. There is more help available than most people at this level realize. The philosophy at level 1, protect what you have and access what's available. Level 2 is stable but stretched. Enough saved that retirement is not a crisis, but not enough that there is significant margin for a large unexpected expense. The primary risk at this level is a single financial event derailing an otherwise workable plan. The most common, or one of the most common issues in Canada is long-term care. 43% of Canadians over age 65 will require some form of long-term care. The average stay runs 18 months to 4 years. Private care ranges from $5,000 to $12,000 per month nationally. A 3-year stay can exceed $200,000. And nearly 74% of Canadians have no financial plan to cover it. Most assume the provincial system will handle it. It will not entirely. Many provincial programs are income-based. The more you have, the more you pay out of pocket. The public wait lists in many provinces are also significant, meaning private care costs often arrive before subsidized placement does. As well, the level of choice, privacy, and surroundings will vary significantly from private facilities, even though the cost may be less. Income coordination matters here. Understanding how CPP, OAS, and RRSP withdrawals interact and which income sources trigger which tax consequences is critical while margins are thin. If you have a defined benefit pension at this level, the survivor benefit election is one of the most consequential decisions you will make. A life-only pension pays more while both spouses are alive. A joint and survivor pension continues to the surviving spouse. That decision cannot be undone, and it's very important to understand and develop a game plan surrounding your DB choice. The philosophy at level 2, every dollar needs a job, and the plan needs to account for what happens if something goes wrong. Level 3 is where most financially prepared Canadians land, and where planning becomes strategic rather than just protective. Meaningful RRSP or RRIF assets, TFSA savings, CPP and OAS, possibly a pension, and non-registered assets are all in play. Income is sufficient, lifestyle is good, but complexity is increasing, and the decisions made in the first few years of retirement set the tax picture for the next 2 decades. According to a Statistics Canada survey of financial security in 2023, the median Canadian family aged 55 to 64 with an employer pension had approximately $335,000 saved in that pension, plus roughly $120,000 in RSP savings. For a dual income couple at this level, the combined picture is meaningful, but the drawdown decision that follows retirement are where the real value is created or lost. The primary risk at level 3 is tax drag and underspending. On tax drag, every RSP dollar is deferred tax liability. Once it converts to a RRIF at age 71, mandatory minimums begin, 5.28% at 71, over 10% by your late 80s. Those withdrawals stack on top of CPP and OAS and potentially scrape past the OAS recovery tax threshold, costing you an extra 15 cents on every dollar worth of income. Many Canadians at this level end up in a higher effective bracket in their late 70s than when they were working. Not by choice, but because income stacks automatically. One way to reduce that tax drag is the conversion window, the years between retirement and age 72 when mandatory minimums begin. Income is at its lowest during that period. Drawing down RSP assets deliberately, filling lower tax brackets, and redirecting after-tax proceeds into the TFSA or non-registered assets can convert a growing tax liability into tax-free savings inside the TFSA or at least tax-preferred assets outside of registered plans. Every year that window sits unused, the opportunity shrinks. On underspending, most Canadians at this level hold back in the early years because they do not know what they can safely spend. Without a written income plan that shows the number clearly, fear and uncertainty drives that choice. A good plan does not just protect you. It gives you permission to spend what you saved in the years when you are most capable of enjoying it. The philosophy of level 3, coordination matters, the accounts, the income sources, the timing, they interact. Getting it right requires seeing the full picture all at once. Level 4 is substantial portfolio, significant RSP or RRIF assets, a well-funded TFSA, strong CPP and OAS, possibly a defined benefit pension from one or both spouses, non-registered and corporate accounts. Survival is not the question. The question is, how much of what you saved do you actually keep? The primary risk is tax inefficiency at scale. Every missed optimization compounds over 25 years to 30 years of retirement. The central insight in this level, not every dollar in that RSP ultimately stays with you. Every dollar is pre-tax. You receive the deduction, then CRA deferred the tax. They didn't cancel it. How much of the eventual withdrawal stays in the household depends almost entirely on account structure and withdrawal sequencing. A retirement funded entirely from a RRIF has one switch. Every time you flip it, income is fully taxable at ordinary rates. A retirement with assets spread across RSP or RRIF, TFSA, and non-registered accounts gives you the ability to choose, in any given year, how much income CRA can see. TFSA withdrawals don't affect the income used to calculate the OAS recovery tax. Corporate account income is sequenced purposefully. RRIF withdrawals are sized to fill brackets deliberately rather than by default. For someone who has been eligible since 2009 and has never contributed, the TFSA room available in 2026 is $109,000 per person, $218,000 for a couple. For Canadians at this level who prioritized RSP contributions throughout their career, building that TFSA during the conversion window is one of the highest value moves available. Pension income splitting at age 65 allows couples to allocate up to 50% of eligible RRIF income to the lower income spouse, reducing the combined marginal rate on every dollar drawn from the registered account. The philosophy at level 4, tax efficiency is the return. Same balance, completely different outcome depending upon the structure. Level 5 is where the planning conversation shifts from income management to optimization, estate efficiency, and legacy. Mandatory RRIF withdrawals on large registered balances can generate forced income well above the OAS clawback threshold. Not because the retiree chose to spend that much, but because CRA's withdrawal schedule requires it. A coordinated strategy of strategic drawdown, TFSA conversion, and charitable giving can meaningfully reduce the taxable estate that eventually lands on the final return. For Canadians at this level who give to charity, donating appreciated non-registered investments directly to a registered charity eliminates the capital gains tax on the growth while generating a donation receipt for the full fair market value. For many donors, the after-tax cost can be significantly lower than donating cash, and it is one of the most efficient strategies available at this level. Your RRIF is the most tax-exposed asset in the Canadian estate. On the second death, the full remaining balance is added to the income in the year of death and taxed at ordinary rates. The strategies that reduce that exposure, systematic drawdown, TFSA conversion, insurance-based solutions, all require time to implement. The earlier they are in place, the more effective they are. The philosophy at level 5, optimization and legacy. The question is not whether you have enough, it's how much reaches the people and the causes you care about, and how much goes to CRA instead. 5 different Canadians are watching this video right now. Each one has a different primary risk and a different planning priority. Someone in level 1 needs to protect what they have and access every benefit that they are entitled to. Someone in level 2 needs income coordination and a long-term care plan before they need it. Someone in level 3 needs to address tax drag and give themselves permission to spend what they saved. Someone in level 4 needs account structure and withdrawal sequencing built before mandatory RRIF income takes over. And someone in level 5 needs optimization, estate efficiency, and a strategy for what gets left behind. No matter which level you're at, the question is the same. Do you have a plan built for your situation? Not a general one, a specific one that accounts for your income sources, your tax picture, your account structure, and how long this all needs to last. Almost every retirement plan has gaps. Finding them now is worth more than discovering them later on. If you identify with one of those levels today and you want to know exactly where the gaps are in your plan, click the link in the description to book a consultation. We're excited to learn more about you and share our Next Step Wealth Management service. Maybe you're not ready for a discussion just yet. As a thank you for being part of this community, I'd like to offer an exclusive book bundle to my YouTube subscribers. So if you haven't already, be sure to subscribe. I'm proud to have co-authored 2 books, Financial Success for Pre-Retirees and Financial Success for Retirees. Both books feature insight and expertise from leading financial advisors across Canada, and I was honored to contribute as one of the authors. Each book normally retails for $27.95, but as a subscriber, you can purchase both books for just $19.99. That's more than 60% off the regular retail price. And even better, your purchase helps make a difference. Proceeds from every book bundle sold are donated to our registered foundation, the Next Step Wealth Giving Fund, which supports Canadian charities dedicated to improving mental health and helping those facing mental health challenges. You'll find a link in the video description that will take you directly to where you can order your books and arrange shipping. And bonus, if you're in the Edmonton or Sherwood Park, Alberta area, you can choose the local pickup option at checkout and save on shipping costs. Thanks for subscribing. See you in the next video. Let's take the next step.